Everyone says debt is bad, but almost no one explains why.
We're taught early on, credit is dangerous, loans are risky, debt equals stress. And yes, if you use it the wrong way, that's true.
The real problem isn't debt. The real problem is how you use it.
There are two types of people. Some use debt to consume. Others use debt to create. Example 1. You take out a loan and buy a car. The car depreciates. Maintenance costs money. Insurance costs money. It drains your cash. That's called a liability. It doesn't pay you, you pay it. Now the second option, you take on debt and buy an asset, real estate, a business, something that generates income. That asset starts producing cash flow. That cash flow covers the loan, and eventually it creates profit. In the first case, debt makes you poor. In the second case, debt accelerates growth. The bank isn't your enemy. Debt is a tool, like a knife. You can cook with it, or you can hurt yourself. Here's how it works. The bank provides capital. You direct that capital into an asset. The asset produces cash flow. And that's when it happens. A bank run. Everyone rushes to withdraw their money, but the bank doesn't actually have it, because most of it was already lent out. If too many people ask for their money back, the bank runs out of cash. Not because it's evil, but because that's how the system works.
Wealthy people don't avoid debt. They avoid bad debt.
And that's also why central banks exist. When banks run out of liquidity, they can borrow emergency funds to survive. So when you deposit your money, it doesn't just sit there. It moves. It gets invested. It powers the economy. And sometimes it creates risk. That's modern banking. So why doesn't the system collapse all the time? Because it's built on trust. Most people don't withdraw their money at once. They trust the bank will give it back when they need it. And as long as that trust exists, the system keeps running. Money flows, loans are issued, businesses grow. Everything looks stable. But trust is invisible. You can't measure it, you can't store it. And the moment people begin to doubt, the entire structure starts to tremble. Banks don't collapse because they run out of numbers on a screen. They collapse when confidence disappears. Because fractional reserve banking only works if not everyone asks for their money at once. Stability isn't optional. It's the foundation. That's why central banks constantly monitor liquidity levels. That's why governments insure deposits. That's why regulators step in at the first signs of panic. Not to control you, but to protect the system from fear spreading faster than logic. Because in banking, panic moves quicker than money.
The problem isn't debt. The problem is how you use it. Use debt to buy assets, not liabilities.